Headline inflation rate at 2.8% looks very encouraging. It suggests that we're on the right path. Is this enough for the Bank of Canada to hit pause and perhaps reverse course?
Yes, so better than expected, that's for sure. Below 3%, that's very good, but it's not enough for the Bank of Canada to relax. First of all, we have to remember that the significant portion of the decline in the CPI inflation was what we call a base effect. Basically, a year ago, gasoline prices went up to the sky. So on a year-over-year, the decline is significant because you start from a very high level. Next month, you will not have this base effect, and therefore, it's not unreasonable to assume that this headline inflation that we are so excited about might go back to 3.2%, above 3%. So that's something that we have to realize. In addition, the core inflation, what the Bank of Canada is focusing on, namely less food and energy, is still elevated. That's something that they are worried about.
You've mentioned core inflation, the gasoline effect. Let's just take a deeper look at those numbers when it comes to food, to housing, to mortgages. What does that look like? Break that down further for us.
Yes, so the core inflation rate, namely, if you take if you exclude energy and food, it's still elevated. However, this core inflation rate is including something very interesting: mortgage interest payments that are rising now by 30%. So think about it for a second. The Bank of Canada is raising interest rates to fight inflation. Higher interest rates are leading to higher mortgage interest payments that are adding to inflation. It's like putting a humidifier and a dehumidifier in the same room and let them go at each other. I think a more reasonable approach is to exclude mortgage interest payments from the calculations. Nobody will be able to convince me that higher mortgage interest payments are inflationary. They are disinflationary. And if you take it out of the calculations, guess what? Inflation is back to 2% already, and at the core level, it's actually below 2%. So this is the way you measure things, and you have to be smart about it. I believe that if you look at the way to really measure inflation and take it out of the story, mortgage interest payments, actually inflation is already a target. We all go to the supermarkets and we know that food prices are extremely expensive, but the question is, are they becoming more expensive faster or not? And to the extent that food prices in terms of inflation are decelerating, although they remain very expensive, this is disinflationary, and that's exactly what we are seeing at this point.
Now, when you take a look at where the numbers are at when it comes to food and energy, where do they have to be? You and I often talk about that lagging effect. Where do they have to be for the Bank of Canada to be comfortable?
Yes, the trick is that the Bank of Canada and Canada as a whole, we are price takers when it comes to food prices, when it comes to energy prices. Listen, I don't know what Putin will do next, but clearly he can have a significant impact on food prices and energy prices globally that will impact Canada directly and indirectly. The only thing the Bank of Canada can do is to focus on what they can impact, which is the domestic economy. And here we have some positive numbers because more and more of this inflation is actually domestically driven as opposed to supply chain, and that's actually good news. So I think that the Bank of Canada, quite frankly, is starting to overshoot. There are major disinflationary forces happening now as we talk. Supply chain is improving, commodity prices are stabilizing, the housing market is slowing. If you take interest payments out of the story, we are already at target. So clearly, there are some disinflationary forces here, and I think that the Bank of Canada has to be very careful not to overshoot. I think that the market is looking at the Bank of Canada to reassess the situation. I think that the Bank of Canada is already overshooting, so I will be very happy if the Bank of Canada does not move in September. I think it's unnecessary.
We're continuing to see the yield curve invert. What does that signal to you?
I think that it definitely signals that the economy is going to slow down. Over the next 6 months, we are going to see the economy performing close to 0.5, 0.6% GDP growth, very close to zero and very close to a technical recession, if you wish. The labor market is relatively strong, and therefore you don't get a real old-fashioned recession. At the same time, it also means that at one point, when the market is starting to realize that the Bank of Canada and the Fed in the US are done, and that will come very, very soon, I hope, the yield curve will start normalizing. You will see the yield curve reaching basically zero, the spread, by the end of this year, and maybe 80 basis points by the end of next year. So we are actually starting to stabilize a little bit, and that's good news.
There have been suggestions that I guess the U.S. is already in a recession. How do you see that when you take a look at our neighbors to the south?
Yes, the question is how you define that recession. Soft landing or a mild recession doesn't make much of a difference. I call it a wannabe recession, if you wish. The only recession that is serious is if you have blood in the labor market, if you have a significant increase in the unemployment rate. So far, the labor market is relatively tight. The unemployment rate is starting to rise, but not in a significant way. As long as the labor market is strong, this recession is not really a real old-fashioned recession. If the Bank of Canada continues to overshoot, moves in September, in October, and after that, then we are going to get a real old-fashioned recession with some blood, unfortunately, in the labor market. And that's why I think it's important for the Bank of Canada to stop now.